Olá pessoal, aqui é Davi Almeida, sou gestor de fundos autorizado pela CVM e hoje, final de ano, clima de retrospectiva, vamos ter uma retrospectiva aí com alguns trechos, né, os melhores trechos das melhores entrevistas que a gente teve aqui já no canal. Nesse primeiro vídeo vou mostrar as entrevistas com os americanos, tá? Então são todas entrevistas aqui em inglês legendadas, tá? Para você. Alguns trechos, alguns highlights, né? Uns trechos muito bons. A gente vai ter aí entrevista com PhD em finanças, fundador da maior corretora de opções do mundo, pessoa que escreveu um livro sobre opções, maior researcher, né? O maior pesquisador ali de opções do mundo, que faz backtest. Então só gente muito, muito fera no mercado. Lógico, né? Conteúdo exclusivo aqui que você só vê aqui na investTV, a gente sempre trazendo grandes traders e grandes profissionais no mercado de opções. Então um pequeno resumo aí com alguns pontos altos dessas entrevistas. Então espero que vocês gostem. Um abraço.
When you're wrong, and I think for most retail investors, you have to have a longer time frame, and that time frame is around a month. That 45-day time frame seems to be the best risk reward to mitigate, to make these daily moves a little bit less in your account, so yeah. You build a wall one brick at a time instead of many bricks in a big wall today, and then you take a lot of it down. You try to build it a little bit slower. So for now, as a retail investor, I'm looking for high implied volatility. I like selling premium. I believe in the math model. Every trade I make, I try to have a 65% pop or better. Pop is just probability of profit. 65% because that's a math bell curve. If you go to any mathematician and if they want to say something like, if you don't want something to happen, what would you want that probability to be? They'd say around 68%. That's one standard deviation. I like to be outside that one standard deviation and let the market beat me. If I'm bullish or bearish, it doesn't matter. I just want the market to beat me.
Okay. So you go more like if you throw a strangle, you look for one standard deviation, a 16 delta put, 16 delta short call, or you're more like 25 delta. What kind of deltas you go for, Tony, when you're throwing this kind of trade?
Anywhere between, I'll give you a wide range and then I'll tighten it up. Anywhere between 30 and 12 delta, depending on the price of the stock. A higher price stock, you can usually go a little further away and still collect enough premium for the amount of money that you're using. And a smaller price stock, you got to go a little bit closer and take a smaller profit a little bit quicker. So anywhere between 30 and 12 delta. If you had to give me my sweet spot, I'd say around 22 deltas.
Yeah.
There's no wrong answer when you're selling premium. I think a lot of people as retail investors get a little bit worried about going closer to the money because their probability of success goes a little bit tighter.
Yeah.
But you're not holding it to expiration. You're not holding it 45 days. There's nothing wrong with taking a trade off 5, 10 days, 15 days after you make it. If you sell a one standard deviation, 15 delta strangle on both sides for $3, and you're trying to make $1.50, and it takes you 3 weeks to do that. Let's make a perfect scenario. 3 weeks, you make your $1.50. If you go a little closer to a 30 delta, and you sell that strangle for $6 or $7, and you try to make that same $1.50. Don't try to make $3.50. Don't try to make 50% on that. Make less. Make that $1.50 that you were trying to make. You'll find out that you'll have a lot more opportunities to take winners, take that money off the table, and then go and do something else with it. I'm not a philosophical trader. Like, I don't get too emotional about anything. But people who kind of take everything as personal, like every trade they make is like, oh, the market maker, which there are no more market makers like me anymore. It's all computers and servers.
Yeah.
The market maker tried to screw me. Like, they don't care about your 1 or 2 contracts. You're more of a nuisance than anything else. Like, they want the market to be wider. If you're a public order, your order has to be shown. So the real market might be this wide, but because there's all these public orders, the market's this wide. I'd much rather, if I'm taking the other side, have a wide market than have a tight market. And I'm going to tell you one thing, and I want your audience to think about this for a minute. As an ex-market maker, somebody who traded against every public order that ever came to the floor, think about this for a moment. Because they always say market makers are evil or bad people. They want to screw you over on your trade. Think about this for a second. If you owned a business and your business relied on somebody coming back every day to do business with your business, like that was the only way you could make money, was if they came back to your store to buy or trade or do something in your business. Every trade that came to the CBOE that traded with me, I wanted them to be successful, because the only way they're going to come back and give me business is if they made money. If they came to my store and I ripped them off 1 time, 2 times, 10 times, they never come back. Yeah. If they never come back, I'm sitting in my store with no business, nothing to do. So as a market maker trading against public orders, I wanted every one of you to be successful. Now, I wanted you to make $1. I wanted to make $5.
Yeah.
That's all it came down to. So there's no true ripping off of the customer on the trade, because you'll go trade Bitcoin, or you'll go trade gym shoes, sneakers, or you'll go trade NFTs.
Open a business, do something else. Yeah.
Absolutely. So everything you did, I wanted you to be successful on. So it was always a fair price on entry.
Yeah. What about the buying power of your portfolio? Maybe a trader could start using, I'm going to use 50% of my buying power here. Mm-hmm. I put some trades on and using 50%. All of a sudden, the market suffers a large move and you're using more. You're using, 70, 80% or even more of your buying power. You think it's a good idea just to manage that, or say, I need to reduce a little bit of that, because probably you're going to have to assume some losses, right?
Yeah, that's a really tricky question. It really depends on the person and the situation. So, and we write about this in the book, like 50% is like the maximum you ever want to allocate to short premium, just because if something like that does happen, you want that portfolio capital to cushion those potential losses. And you really want that reserve capital to be able to capitalize on those high volatility conditions where you have very rich premiums. So it really depends on the person and the constraints of the market. So like, for instance, in the last couple of weeks, I had, a bunch of positions, or like even since 2020, I had a bunch of positions that would dip into the money. And then I would just kind of wait it out to see if they would kind of bounce back. And that's what wound up happening. So in those conditions, for instance, like even though my buying power went up, I didn't actually manage the positions, and I just wanted to wait it out because of the duration of the contracts. If you're dealing with that situation and you're dealing with like 10 DTE contracts where the volatility of those positions are very high, it might make more sense to sort of close those positions, recenter, take some losses, and then try to capitalize on the volatility contraction. That's a little bit more likely now that IV is elevated. Does that make sense? It really depends on like how much risk you're willing to take given the current conditions.
Our goal for as trader, our goal is not like try to make $50 to buy a Starbucks, couple of Starbucks for the whole week. Then the rest of my life is good. We're trying to make some profit, right? We're trying to make some wealth. So eventually you will grow your trading account from $5,000 to $20,000 to $50,000 to $100,000 even more, because why we become junk trader or addicted to option trading, because we want this one way or one very effective vehicle to create some of the wealth. So if you want to do that, eventually you will step up to the phase 3, which is you want to become a smart portfolio manager. Because in phase 2, you can trade Tesla, you can trade Apple. I can speculate the GME. I can speculate some Brazil very volatile stock and make some money and lose some money. But eventually, after you get married, you make more money from your salary. you start to think about how am I build up kind of a wealthy portfolio that can sustain my lifestyle or whatever, right? So that's where the portfolio management comes in. It's become extremely important. Now you're talking about a big plan and in a different strategic level. You want to know how much money I have, or down the road, I'm going to commit it to the trading, to trade options, how much I'm committed to just long stock or real estate or whatever. For option trading, then you need to know how much capital I want to constantly allocate it into this trading environment. When the implied velocity is high, when the implied velocity is low, when the market is extremely good, like the US in the past 7 years, how much capital I want to allocate, what kind of position I want to put in. If the interest rate is going to increase, something uncertain is going to happen down the road to the world, to US or to the Brazil, then how should I adjust my portfolio? I'm not talking about I should manage your position at 21 days before expiration or 15. These are kind of micro. But when you're talking portfolio management, you need to know what kind of sector I need to commit more capital and how many position I need to allocate. Should I increase my number of underlying from 15 to 30? Then increase the number of position from 1 for each underlying to 2 or 3 for each underlying. So total would probably have 90 positions, 30 underlying, 90 positions, or we want to downsize to 20 underlying, but each underlying I have 5 positions. So these are kind of in a bigger scale, how you want to manage your position. And also how much capital I need to allocate to naked position and how much position I want to allocate to the cover call or the risk-defined strategy like the call spread, put spread, and condor. So these are kind of in a different level. If you're able to focus more on this side, right? I constantly monitor my portfolio about the data delta ratio, how many data I collect on each day. These are kind of in a bigger picture. Everyone need or will need to master when they trade a little bit bigger portfolio.
So Tom, when was the time came where you realized options are made for selling, and to sell options is much better than buying options? Because I know people that the years go by and they don't came to that conclusion. People just keep buying out of the money options. And when it hits you,
it's very difficult, and I don't know if I got there in my first 20 years because when you're a market maker, you're not really the one initiating the trade. You're the one making a trade based on what somebody else wants to do. So I didn't think about it the same way. But as soon as I became a retail investor in 2001, when we built Thinkorswim, at that point, I knew I was only selling.
I think you like the ratio spreads, right? You said a lot. You're a big fan of those strategies. I like to myself. Here in Brazil, we call booster. No one calls ratio spreads. We just call the booster. There's the same
booster.
Trade. Booster. Say like you're boosting a covered call when you do it with calls. Some people call a asymmetrical spread too. But since you're an expert in the ratio, how you set up? Can you give us any tips? How you do it? What deltas do you use? What kind of how exactly you like to do this strategy specifically?
Yep. So I'll give people a couple of things to think about when it comes to the booster strategy. I love that. I may start using that. That's really good because that's exactly what it kind of is. That's really cool. So here are a couple of things to think about when it comes to a ratio spread. I almost always use put ratio spreads. I don't usually use call ratio spreads for the same reason that I don't like to have naked calls, because that's effectively what you have on with a call ratio spread, the extra naked call. I don't like to get into that for all the reasons we've already talked about. So I normally do put ratio spreads. Okay. With the put ratio spread, there's kind of 2 different ways that you can play this. You can play it in a way that's going to be a little bit more, let's call it tasty trade approved. And then there's going to be another way that you could use them that's maybe not so tasty trade approved. So don't let Tom know that I shared this with your audience, but I want to give you guys some things that maybe you can't find anywhere else. So number one, if you do kind of the tasty trade approved ratio spread, which is very effective, and this is what I do on my show all the time, you're going to want to enter the trade around 45 days to go, exit the trade around 21 days to go, just pretty standard short premium situation. You wait for high implied volatility, you wait for high implied volatility rank, you sell that premium, and you're putting yourself in a really good spot. One of the ways you really want to utilize that strategy is consider using very narrow strikes. So, maybe only $1 between your long and your short, maybe only $2 between your long and your short. And the reason why you want to do that is if you narrow the distance between the long option and the short option, you're going to be able to boost the credit that you collect on the strategy. And by boosting the credit that you collect on the strategy, if the stock does rally and the options move further and further out of the money, you're going to have a greater credit that you're going to be able to cash in on because you maximize that credit on order entry. And so it's going to be a lot easier of a trade to manage at 21 days to go or when you realize a profit or whatever. That's one way that you could use this strategy. Here's a second way that you could use this strategy. If you want to deviate from the tasty trade mechanics just a wee little bit, consider using wide ratio spreads. So you could consider going really wide with your ratio spread. And I mean like super wide, $7 wide, $10 wide, maybe $15 wide, whatever. Do this in the index products and maybe consider taking those closer to expiration. And here's the reason why. You're not necessarily going to collect a huge credit because you're widening out the ratio spread. You probably still want to bring in some kind of a credit. So that way, if the stock does rally, you can at least make a little something. But you can use these as a really good hedge against a long portfolio because with the super wide spread that's baked in there, that spread could bring in a nice little bonus kicker if the stock actually falls inside of your strikes at expiration, which that could be a situation where the rest of your portfolio, if it's long, is getting hurt. But this ratio spread or these ratio spreads, if you put on more than one, they can actually be profitable in that scenario where you land between the long strike and the short strike, and they can become super profitable if that happens to happen near expiration. And so ratio spreads in terms of making max profit where you pin that short strike, that can only happen at expiration. Well, again, with what we do every day at Tasty Trade, if I'm in at 45 and I'm out at 21, I'm never going to be around to enjoy that, if that makes any sense. But if I widen it out and I carry it a little bit closer to expiration, you got to be a little careful with that because, you are exposing yourself to more gamma risk and things like that. But it's just a little something to think about, just a little something to kick around in the old noggin there.
E aí, curtiu o vídeo? Então deixa seu like, o like ajuda bastante a gente a continuar postando esse tipo de conteúdo. Meu nome é Davi Almeida, esse aqui é investTV. Um abraço a todos e até o próximo vídeo.